Risk changes over time. The riskiness of an asset class can change over time. This image shows how the risk of 4 traditional asset classes changed over 5-year rolling periods from 1926 to 2016. Rolling period returns are a series of overlapping, contiguous periods of returns. In this case, the first period return is 1926 to 1930. The second is 27 to 1931, etc. While small stocks and large stocks are more volatile than government bonds and treasury bills, there are times when assets considered less risky exhibit greater volatility. Notice that government bonds and treasury bills have generally been more risky since the 80s than they were in earlier decades. Small stocks, while still the most volatile asset classes, were less risky in recent periods than they were in the 30s. Risk is measured by the standard deviation of annual returns. It measures the fluctuation of returns around the arithmetic average return of the investment. The higher the standard deviation, the greater the variability and thus risk of the investment returns. Government bonds and treasury bills are guaranteed by the full faith and credit of the U.S. government as to the timely payment of principal and interest, while stocks are not guaranteed and have been more volatile than the other asset classes. Furthermore, small stocks are more volatile than large stocks and are subject to significant price fluctuations, business risks, and are thinly traded. Some disclosures about the data. Small stocks are represented by the Ibbotson Small Company Stock Index. Large stocks are represented by the Ibbotson Large Company Stock Index. Long-term government bonds by the 20-year U.S. government bond, and treasury bills by the 30-day U.S. Treasury bill. An investment cannot be made directly in an index.